Active equity investing seeks to generate returns that exceed a designated benchmark through informed security selection, portfolio construction, and risk management. Within the program, active management approaches are broadly classified as fundamental or quantitative. Although both aim to identify mispriced securities and exploit market inefficiencies, they differ significantly in how investment decisions are made. Fundamental investing relies on human judgment, experience, and qualitative assessment, whereas quantitative investing depends on systematic models and data-driven rules. Understanding the strengths, weaknesses, and implementation processes of each approach is essential because modern investment organizations frequently combine elements of both methodologies to create more robust portfolios capable of delivering consistent risk-adjusted returns. Fundamental active management is primarily driven by analyst expertise and subjective evaluation. Portfolio managers conduct extensive research on companies, industries, and economies to estimate intrinsic value and identify securities trading at prices that differ from their perceived worth. This process typically involves analyzing financial statements, management quality, competitive positioning, industry trends, and macroeconomic conditions. The resulting forecasts are translated into valuation estimates that guide investment decisions. High-conviction ideas generally receive larger portfolio allocations, resulting in concentrated positions relative to quantitative portfolios. Because success depends heavily on analytical skill and judgment, fundamental managers must continually evaluate assumptions, monitor changing business conditions, and reassess valuations as new information becomes available. The fundamental investment process follows a structured sequence designed to convert research insights into portfolio returns. Managers begin by defining the investment universe and establishing a clear investment thesis. They then pre-screen securities to reduce the universe to a manageable set of candidates for detailed analysis. Subsequent steps include evaluating industries, assessing competitive advantages, forecasting earnings or cash flows, and converting forecasts into valuation estimates. Portfolio construction incorporates risk controls and any relevant top-down views on sectors or markets. Finally, managers establish buy and sell disciplines and periodically rebalance holdings. Common challenges include behavioral biases such as overconfidence, confirmation bias, loss aversion, and regret aversion, all of which can impair decision quality. Quantitative active management relies on statistical techniques, mathematical models, and systematic rules rather than subjective judgments. Managers collect large quantities of financial and market data and use quantitative models to identify patterns associated with future returns or risks. Once a model is developed, investment decisions are executed consistently according to predefined rules. Quantitative portfolios often hold a larger number of securities with smaller individual position sizes because diversification helps capture statistical relationships across a broad universe. The systematic nature of quantitative investing improves consistency, reduces emotional decision-making, and allows rapid processing of information. However, success depends on the quality of data, model design, and the persistence of identified relationships. The quantitative investment process generally consists of defining a market opportunity, acquiring and processing data, developing and backtesting models, evaluating strategy performance, and constructing portfolios. Backtesting is particularly important because it allows managers to assess how a strategy would have performed historically before committing capital. However, quantitative investing faces unique risks. These include survivorship bias, look-ahead bias, overfitting, data mining, unrealistic assumptions regarding turnover, transaction costs, and limitations related to short selling. A model that appears highly successful during historical testing may fail in real markets if relationships are spurious or if market conditions change significantly. Therefore, rigorous validation and ongoing monitoring are essential. One important category of active management is factor-based investing. A factor is a characteristic that exhibits a consistent relationship with asset returns or risks. Common examples include value, size, momentum, quality, and volatility. Factor-based managers rank securities according to selected factors and build portfolios that overweight attractive characteristics while underweighting less desirable ones. Successful factors are known as rewarded factors because they are associated with persistent risk premiums over time. Managers must ensure that factors possess economic rationale and are not merely the result of data mining. Factor-based strategies can be implemented using either quantitative models or fundamental insights, demonstrating the overlap between the two broader approaches. Active management strategies can also be categorized according to their investment perspective. Bottom-up strategies focus on identifying attractive individual securities regardless of broader market conditions. Examples include value investing, growth investing, distressed debt investing, and income-oriented approaches. In contrast, top-down strategies begin with macroeconomic analysis and allocate capital across countries, sectors, industries, themes, or volatility regimes. Top-down managers may use broad market exchange-traded funds, derivatives, and sector-specific vehicles to express their views. Thematic investing, climate transition opportunities, technological innovation, and regulatory changes are common examples of top-down themes. Successful managers often integrate both approaches to combine macroeconomic insights with detailed security analysis. Additional active strategies include activist investing, event-driven investing, statistical arbitrage, and market microstructure strategies. Activist investors seek to influence corporate decisions to unlock shareholder value, while event-driven investors exploit opportunities surrounding mergers, restructurings, and other corporate events. Statistical arbitrage strategies use quantitative techniques to identify temporary pricing anomalies expected to revert to historical norms. Market microstructure strategies focus on trading dynamics, liquidity, and execution inefficiencies. Regardless of the specific methodology employed, all active strategies share a common objective: generating excess returns relative to a benchmark while appropriately managing risk. Understanding the rationale, implementation process, and limitations of each strategy is critical for evaluating managers and constructing effective investment portfolios.